Let me ask you something uncomfortable. If money is just paper, why does it control your entire life? Why does a number on a screen decide where you live, how you feel, and whether you sleep peacefully at night? Here's the truth most people never hear. You don't actually understand money. And that's not your fault. Because the system that runs your life was never designed to be understood by you. It was designed to be used by you. In the next few minutes, I'm going to show you how money is really created, why debt isn't an accident, and how most people are playing a financial game without ever being taught the rules. And once you see it, you won't be able to unsee it. Blue Book Chapter 1. What Money Actually Is, expanded, 800 words. Most people think money is wealth. It's not. Money is a social agreement. It only works because we collectively agree that it works. Take the US dollar. It has no intrinsic value. It isn't backed by gold. It isn't redeemable for a fixed amount of any physical commodity. It's what economists call a fiat currency, which simply means it has value because the government declares it legal tender and the public believes in it. That belief is everything. Money is trust. That's the foundation. If you strip away the symbols, the design, the digital interfaces, what you're left with is confidence. The confidence that someone else will accept what you're holding in exchange for something real. Food, shelter, labor, time. When you receive a paycheck, you are not receiving wealth itself. You are receiving a claim on wealth. A transferable promise that someone else will exchange goods or services for those numbers in your account. That distinction matters. Because wealth is tangible. Wealth is productive capacity. Wealth is land, businesses, skills, technology, infrastructure, energy, and human labor. Money is simply the measuring tool we use to move that wealth around efficiently. Money is the receipt, not the product. And this belief system, this shared trust, is incredibly powerful. It allows millions of strangers to cooperate without knowing one another. It allows complex economies to function smoothly. It enables specialization, trade, and growth on a massive scale. But it's also fragile, because it depends entirely on confidence. If confidence erodes, the system shakes. History has shown this repeatedly. Bank runs, currency collapses, inflation spirals. These events are not caused by paper losing value. They're caused by belief losing stability. Once enough people question the promise weakens. And here's where things become more interesting. Most people believe banks store money. They don't. That image, your deposit sitting safely in a vault, is outdated. Modern banking doesn't function like a storage warehouse. It functions like a multiplier. When you deposit money into a bank, it does not remain untouched. Banks operate under what's called fractional reserve banking. This means they are required to keep only a fraction of deposits available as reserves. The remainder can be loaned out. So if you deposit $1,000, the bank may only be required to hold a small percentage of that amount. The rest can be used to issue loans. And here's the critical detail most people never realize. When banks issue loans, they're not simply transferring existing money from one account to another. They create new money, digitally. If you take out a $300,000 mortgage, that money is not pulled from someone else's savings account and handed to you. The bank creates a new deposit in your name. The moment the loan agreement is signed, new money enters the system. The loan expands the money supply. This is not speculation. It's how modern banking works. Which means something profound. Most of the money circulating in the economy exists because someone owes it back, with interest. Debt creates money. Read that again. Debt creates money. This changes everything about how you view the system. Because it means the financial system is not built primarily on savings. It's built on borrowing. Savings do not expand the money supply. Loans do. When businesses borrow to expand, when individuals take mortgages, when corporations issue debt, new money enters circulation. When loans are paid off, that money effectively disappears from a system. Now think about what that implies. If loans are paid off faster than new loans are created, the money supply contracts. When the money supply contracts, economic activity slows. Spending decreases. Investment drops. Growth weakens. That's why central banks monitor credit markets so closely. That's why policymakers respond aggressively during financial crises. Because the system depends on ongoing credit expansion to maintain stability. Debt is not a side effect of the system. It is the engine. The entire structure relies on a continuous cycle of lending, spending, earning, and repayment, with interest layered on top. This doesn't mean the system is evil. It means it is structured around growth. Growth in borrowing. Growth in production. Growth in consumption. And once you understand that, something shifts in how you interpret financial pressure. When you see rising household debt, expanding corporate loans, and growing national deficits, you're not witnessing a glitch. You're witnessing the mechanism in motion. The system is designed to expand. And expansion requires credit. So when people struggle financially and assume they've personally failed, they're often missing the broader context. They are navigating a structure that incentivizes borrowing, normalizes leverage, and depends on participation. Once you see that money itself is trust, and that most of it is born from debt, you realize something critical. The system isn't broken. It's functioning exactly as designed. And understanding that design is the first step toward navigating it intelligently. Now that you understand how money is created, we need to talk about what keeps the system running. Interest. Interest is where the structure reveals its deeper logic. Imagine a bank creates $1 million in loans at 5% interest. That $1 million enters the economy as new money. Businesses spend it. Families use it. It circulates. But here's the catch. Borrowers don't just owe $1 million back. They owe $1,050,000. The extra $50,000 was never created in the original loan. So where does it come from? It must come from economic growth, from new income generated somewhere in the system. And in many cases, it comes from additional borrowing. More loans create more money. More money allows previous loans to be serviced. This creates a self-reinforcing cycle. Expansion feeds repayment. Repayment requires expansion. This is why modern economies are obsessed with growth. When GDP slows, markets panic. When lending tightens, recessions follow. When borrowing freezes, crises emerge. Because if the system stops expanding, the pressure builds. This isn't a conspiracy. It's mathematics. A debt-based monetary system functions most smoothly when there is steady growth. That growth can come from innovation, productivity, population increases, or credit expansion. But without it, the system strains. Now zoom in to the personal level. Why does it feel like you can never quite get ahead? Because the same growth logic applies to your life. The average American household carries significant debt: mortgages, auto loans, credit cards, student loans. Debt isn't unusual anymore. It's normalized. It's expected. And culturally, it's encouraged. Modern consumer culture equates success with visible consumption. A larger home signals achievement. A new car signals progress. Upgraded technology signals relevance. These signals are subtle but powerful. They shape identity. And here's the genius mechanism of the system. Debt allows you to access that identity immediately. You don't need to wait 10 years to save for the house. You don't need to accumulate cash for the car. You can have it now. Debt is financial time travel. You pull future earnings into the present. And that feels empowering, at first. But time travel has consequences. Every monthly payment represents future labor already committed. Every interest charge represents money you must earn before you're free to choose differently. Over time, obligations accumulate. And something psychological happens. When your fixed expenses are high, your flexibility shrinks. You become cautious. You hesitate to change careers. You hesitate to start a business. You hesitate to take risks. Not because you lack ambition, but because you can't afford instability. Debt doesn't just affect your finances. It affects your behavior. It stabilizes you. And a stable, predictable workforce benefits the broader economic system. Employers rely on consistent labor. Lenders rely on consistent payments. Markets rely on steady consumption. Again, this isn't about secret villains. It's about incentives. The structure rewards expansion and participation. Financial products are designed accordingly. Credit cards advertise rewards while charging high interest rates. Minimum payments are structured to extend repayment timelines. Auto loans stretch to 6 or 7 years. Mortgages span decades. Complexity adds another layer. Annual percentage rates. Variable interest adjustments. Late fees. Compounding schedules. Most people don't study these details deeply. And when confusion leads to costly mistakes, individuals often blame themselves. I should have read the fine print. I should have been more disciplined. But zoom out. You're operating inside a system designed to encourage borrowing, spending, and long-term repayment. The cultural narrative says higher income solves everything. But income alone doesn't break the cycle. If lifestyle rises as income rises, debt often follows. A promotion leads to a bigger house. A bonus leads to a more expensive vehicle. A salary increase justifies new obligations. This is called lifestyle inflation. And it keeps people on a treadmill, running faster, earning more, but rarely building freedom. Because growth in income without growth in assets doesn't change your structural position. You're still trading time for money. You're still servicing obligations. The growth machine keeps turning. And here's the deeper insight. The system doesn't require you to fail. It only requires you to remain engaged. As long as you borrow, spend, and repay with interest, you're contributing to the engine. And most people do this unconsciously. They assume debt is just part of adulthood. They assume financial stress is a personal weakness. They assume the pressure they feel is normal, because everyone around them feels it too. But once you understand the growth logic behind the system, something changes. You stop viewing debt as morally neutral. You begin asking strategic questions. Is this debt building an asset or funding consumption? Is this obligation increasing my future options or reducing them? Am I expanding my income-producing capacity or expanding my lifestyle commitments? The system itself isn't disappearing. Growth will continue to drive policy, lending, and culture. But awareness gives you leverage. Because once you see the growth machine clearly, you can decide how deeply you want to be entangled in it. You may still participate, but you won't participate blindly. And that difference between unconscious participation and strategic engagement is where financial autonomy begins. Now that you understand how money is created and why the system depends on growth and debt, there's one final question. Is there a way to win inside this structure? The answer isn't to escape the system entirely. That's unrealistic. The answer is to understand how different players use the same rules. Because here's the truth. The wealthy do not operate outside the system. They operate differently within it. Most people use debt to consume. Wealthy individuals use debt to acquire assets. That single shift changes everything. When the average person borrows money, it's often for things that decline in value: cars, electronics, lifestyle upgrades, vacations. These purchases may improve comfort or status, but financially, they don't generate income. The debt remains. The asset depreciates. The payment continues. But when financially sophisticated individuals borrow, they typically do so to purchase income-producing or appreciating assets: real estate, businesses, equity investments, productive assets. Their debt increases, but their assets increase faster. And that's the difference. Debt tied to consumption reduces flexibility. Debt tied to productive assets can increase leverage. This is where the concept of leverage becomes powerful. Leverage simply means using borrowed money to amplify potential returns. If an investment earns a higher return than the cost of borrowing, the spread creates wealth. For example, if someone borrows at 5% and invests in an asset earning 8 to 10%, the difference compounds over time. This strategy carries risk, and it requires discipline, but it illustrates something important. Debt itself is neutral. Its impact depends on what it's attached to. Now let's talk about compound interest. Most people experience compounding on the negative side, through credit cards or high-interest debt. Balances grow. Minimum payments barely reduce principal. Interest accrues on interest. Compounding becomes a trap. But on the asset side, compounding becomes transformative. If you invest consistently over decades, returns begin generating their own returns. Growth accelerates not because of effort alone, but because of time. Time is the multiplier. A modest investment started early can outperform a larger investment started late. That's not motivational rhetoric. It's mathematics. And here's where the structural advantage becomes visible. Many wealthy families introduce investing early. Children grow up understanding ownership, shares, businesses, property, rather than just employment income. Assets are often transferred across generations. This creates momentum. By the time some individuals enter their 30s, their assets are already producing income. dividends, rents, business cash flow. Meanwhile, many others are just beginning to stabilize financially, paying off student loans, building credit, recovering from early mistakes. This doesn't mean upward mobility is impossible. It means starting position matters. But here's the empowering part. Understanding the system allows you to shift your trajectory, even gradually. You may not begin with generational wealth, but you can begin with awareness. Instead of asking, "How can I afford this lifestyle?" you begin asking, "How can I acquire assets that fund my lifestyle?" Instead of increasing expenses with every income raise, you increase ownership. Instead of signaling success through consumption, you build it quietly through accumulation. That shift is subtle, but profound. It changes how you view promotions. It changes how you view debt. It changes how you view spending. You stop measuring success by visible upgrades. You start measuring success by optionality. Optionality is the real currency of financial freedom. The ability to say no to opportunities that don't align with your goals. The ability to leave environments that no longer serve you. The ability to absorb unexpected events without panic. And optionality comes from reducing obligations while increasing assets. This doesn't require extreme austerity. It requires intention. You don't have to reject comfort. You simply avoid financing identity with long-term debt. You don't have to avoid borrowing entirely. You ensure borrowing contributes to asset growth. You don't need to predict markets perfectly. You need consistency over time. The system is not designed to make everyone wealthy. It is designed to maintain expansion. But individuals who understand expansion can position themselves alongside it rather than beneath it. They allow assets to grow with the system. They allow time to work in their favor. And perhaps most importantly, they stop blaming themselves for structural pressures. Financial stress often feels personal, but much of it is systemic. When you understand that money is trust, that debt creates supply, that growth sustains stability, and that incentives shape behavior, you gain perspective. Perspective reduces emotional decision-making, and emotional control improves financial outcomes. You may never become a billionaire, but you can reach a point where money serves your goals instead of dictating them. Where income funds investments. Where investments create income. Where time compounds quietly in the background. And that's the real shift. From survival to strategy. From consumption to ownership. From reaction to intention. The game hasn't changed. But you have. And once you understand the rules, you're no longer just participating. You're playing intelligently.